The Trump administration has quietly moved to put new tariffs on hundreds of items, including many that you use every day.
Uncertainty about his economic plans, specifically the cost of those tariffs, have caused a Trump slump.
Hey everyone, welcome back. Have you noticed how lately the American economy feels a little unsteady? The numbers sound good one week and then completely shift the next. Well, you're not imagining it. For months, analysts believed things under the Trump administration were looking surprisingly strong. But fresh reports have painted a shakier picture, leaving investors, workers, and economists wondering what's really going on. Today, let's break this all down step by step and figure out why the U.S. economy suddenly looks far less stable than people thought. In the immediate aftermath of what Donald Trump proudly described as Liberation Day, a good number of financial analysts were convinced that the American economy was heading into dangerous territory. Stock prices tumbled, bond yields jumped higher, and the U.S. dollar slipped against nearly every other major currency. For many economists, that was the opening act of what looked like a looming crisis. Yet, much to Trump's satisfaction, the crash never really arrived in the way people expected. Instead, for several months, government data suggested inflation was under control and employment figures were strong, helping push Wall Street toward record-breaking highs. That steady narrative lasted until late last week, when new reports on inflation and jobs landed. The data contradicted earlier optimism, showing that the economy might not be as healthy as people assumed. What once seemed like a story of resilience has started to look more fragile. So, in this discussion, we'll unpack why the United States economy appeared stronger than expected just weeks ago, and why the latest numbers have economists changing their outlook. Before diving into the bad news, let's rewind a little and understand what made the economy appear so robust earlier this year. Two major factors shaped that view: inflation trends and overall growth. Inflation that defied expectations. Conventional wisdom among most mainstream economists was that Trump's policies would inevitably push inflation higher. His trade wars, frequent tariff announcements, and unpredictable economic strategies were thought to weaken the dollar and drive up the cost of imports. If goods coming into the country become more expensive, households usually feel the squeeze, and prices across the economy climb. Surprisingly, that's not what happened, at least not at first. When Trump entered office, headline inflation hovered around 3%, but instead of climbing further, it slipped down to 2.3% by April, just above the Federal Reserve's preferred 2% target. By May, inflation ticked up slightly to 2.4%, and in June, it reached 2.7%. Even so, these numbers were still better than most predictions, which expected much worse. One big reason for this unexpected relief was falling global energy prices. Oil dropped from around $80 a barrel in January to roughly $65 by the middle of the year, and anyone who has followed inflation knows how dramatically energy costs influence broader price levels, from transportation to production to heating homes. A steady decline in oil prices gave Trump a lucky cushion, growth that seemed resilient. Inflation wasn't the only metric surprising analysts. GDP growth appeared stronger than expected too. Many experts initially predicted Trump's erratic tariff strategies would discourage foreign investors and shake consumer confidence at home. That sort of uncertainty usually slows both spending and investment, which drags down growth. But once again, the numbers looked brighter than the forecasts. While the economy did contract a little in the first quarter, many attributed that dip to businesses rushing to import goods before tariffs took effect. Because GDP is partly calculated as exports minus imports, that spike in imports temporarily lowered the headline figure. But by the second quarter, growth bounced back with an annualized rate of 3%, which is considered solid performance. Jobs numbers also appeared encouraging. In June, the Bureau of Labor Statistics reported the economy had added 147,000 jobs, beating expectations of around 115,000. The general assumption is simple: more jobs equal a stronger economy, with both inflation relatively tame and employment looking robust. The story for Trump was that the economy was holding up remarkably well despite his controversial policies, a shift in the data. However, this optimistic storyline headline changed with the arrival of new reports at the end of last week. First came the Core Personal Consumption Expenditure Price Index, known as the PCE. This is a critical measure for the Federal Reserve because it strips out volatile categories like food and energy, offering a clearer picture of underlying inflation trends. The PCE showed a jump in June, rising 0.3% from the previous month and 2.8% compared to a year earlier, well above the Fed's 2% target. That meant inflationary pressures were building after all. Even worse, the data suggested the rise wasn't driven by healthy consumer demand. Consumer spending overall increased by only 0.1%, and most of that was in healthcare, housing, and utilities, not exactly the type of discretionary spending that signals confidence. This indicated that tariffs were finally showing their inflationary impact. Initially, many businesses chose to swallow higher costs, hoping Trump might change course. But with no policy reversal in sight, the pressure was now filtering into prices. The disappointment didn't stop there. The July jobs report turned out to be deeply concerning. Instead of adding another six-figure number of jobs, the U.S. economy created just 73,000 positions. To make matters worse, previous data was revised dramatically downward. June's estimate dropped from 147,000 jobs to only 14,000, while May's revision cut the figure from 144,000 to just 19,000. That sort of revision is hard to overstate, painted a far weaker picture of the labor market than anyone had believed. Excluding the pandemic years, this was the weakest three-month period of job growth since 2010, when the nation was still clawing its way out of the Great Recession. Even the limited job growth was lopsided. Healthcare accounted for most of the new positions. Stripping that out, job creation was basically flat in July and actually negative in the 2 months before. Meanwhile, the headline unemployment rate looked deceptively stable because more Americans of working age were being categorized as economically inactive. These are individuals not seeking work and therefore not counted in the official unemployment figures. If they were included, the actual unemployment rate would rise to 4.9%, the highest since late 2016. Outside the pandemic era, rethinking GDP growth, the weak employment report also casts new doubt on the earlier GDP numbers. Yes, the second quarter showed an impressive 3% annualized growth rate, but closer inspection revealed much of it came from unusual temporary factors. Exports spiked after the earlier surge of imports, which was an expected rebound effect. More striking, however, was the role of artificial intelligence investments. America's so-called Big Seven tech companies spent more than $100 billion in just one quarter building massive data centers to fuel AI projects. Nearly a full percentage point of GDP growth came from AI-related investment alone, more than what domestic consumption contributed. This spending spree had ripple effects too. Construction workers hired to build those data centers injected their wages back into the wider economy, adding to the temporary boost. On Wall Street, excitement over AI pushed stock prices to new highs, further lifting confidence among investors. But here's the catch. If AI truly transforms productivity, then this might represent genuine long-term growth. If not, or if the payoff takes longer than hoped, the boom could fizzle out. A slowdown in AI investment would not only dent GDP growth, but might also rattle the stock market, increasing the risk of recession, an economy on shaky ground. All of these developments, rising inflation, slowing job creation, reliance on healthcare employment, and a heavy dependence on AI-driven investment have left analysts warning that the United States economy is beginning to resemble stagflation. That's the dreaded combination of stagnant growth with rising inflation, a scenario that frustrates both workers and policymakers. And this economic wobble fits into a broader narrative about America's shifting role in the world. Once seen as a stabilizing anchor in global politics and finance, the U.S. now appears less steady. Its influence and prestige are under increasing pressure both at home and abroad. In fact, this is the theme of the latest edition of Too Long magazine, which explores the idea that we may be witnessing the decline of the so-called American order. The issue doesn't just look at the economy, but also at deeper concerns: the erosion of democratic norms, the weakening of U.S. soft power, and cultural battles over education and institutions. It even raises the question of who might step up in a world where America no longer sets the pace. The magazine dives into related global stories too like Germany's expanding military capabilities, whether Farage could actually become Britain's prime minister, and how countries are outsourcing their migration issues. It features perspectives from figures like Professor James Kindi and analyzes why leaders such as Putin and Netanyahu seem able to hold on to power despite growing controversies. This particular edition is their longest ever, running 78 pages, packed with detailed reporting and analysis. Subscribers not only get access to the digital version instantly, but also discounted rates for future issues. The editors argue that supporting independent media like this is vital, especially since their platform, TLDR, actually lost money last year. Subscriptions are part of the plan to keep the operation financially sustainable, while continuing to release free daily content. To sum it all up, just a few weeks ago, the American economy looked like it was defying the odds-low inflation, solid growth, and strong employment numbers. But the latest reports have shaken that confidence. Inflation is creeping higher, job growth has slowed dramatically, and GDP is relying too much on unusual temporary factors like AI spending. Add in the growing sense that America's global influence is weakening, and it's clear why many observers are worried. Whether Trump ends up presiding over a genuine AI-driven economic boom or a painful correction remains to be seen. For now, though, the U.S. economy looks less like a story of resilience and more like one of fragility.